So friends, today we will be starting a new chapter. It is called the Financial Analysis Techniques. This is part of the Financial Statement Analysis segment in CFA Level 1. So, Financial Analysis Techniques. What do you mean by this financial analysis? So friends, whenever we are trying to analyze any business, there are two aspects to it. One thing is, we want to find out certain absolute parameters or absolute analytical factors about that company. And there are some relative comparative analysis that we want to do about the company. And both the absolute factors and the relative factors may use financial data, may use some qualitative data like news. In the same way, relative factors also may use financial data and also some qualitative data, non-numerical data, right? For absolute and relative analysis factors, when we are using financial data, right? When we are using financial data, they fall in the category of financial analysis techniques. Okay? So let us define financial analysis techniques. So financial analysis techniques are methods and techniques applied on the available financial information of a business to make interpretations about the security representing it or its underlying business. So financial analysis techniques are methods and techniques applied on the available financial information to make interpretations about a security or its underlying business. And the financial information obviously is pertaining to the underlying business only. It's financial statements, basically the cash flow, the balance sheet, the profit and loss, etc., etc. Now we were talking about absolute factors and relative factors. Let's take some examples of absolute analysis and relative analysis now. Let's say an automotive company has a return on equity of 35% and its debt to equity is 0.2. Debt to equity means the ratio of debt and equity. Return on equity means the ratio of earnings and book value, right? We will get to these terms in a very short while. This is earnings to book value, this is debt to equity ratio. Now, in absolute terms, the debt to equity ratio is quite good. The debt is low, basically. Because you see, it's 0.2. That means 2 by 10. This is the ratio of debt and equity. So this is a good ratio to have. And 35% return on equity under this condition of low debt to equity is also very good. Now what we are doing here, friends, we are actually analyzing in absolute terms. This is financial analysis in absolute terms. Now what is a relative analysis? Let's say there is another company we are comparing this to. So ROE of another company is 30% and its debt to equity ratio is 0.5. Obviously, if you compare this company with this one, the number of the first analyzed company looks more attractive. This is also good. In its debt to equity of 0.5 is not decent, not bad. In absolute terms, ROE of 30 under a debt to equity ratio of under a low debt scenario like this is quite good. But if you compare both, then the first company, that is company A, if you term them company A and B, company A seems to be more attractive, right? Now, when doing financial analysis, a few things have to be considered. The first thing that has to be considered is, what is the purpose? What is the purpose of the analysis? For example, are we trying to find the intrinsic value of the company? Are we trying to find some relative pricing parameter of the company like P ratios or P growth ratios? Are we trying to understand the debt scenario of the company? So what is the purpose? What is the purpose of the research? Number 2 is, what is the data available? So, is the data that we need found in the profit and loss statement? Is it found in the cash flow statement? Is it found in the balance sheet? Or is it not found in any of them? You have to check the notes in the annual report. Or you have to check the quarterly reports for it. This is what we have to understand. Third is the level of detailing that is required. So for example, we can say the revenue of a company is 1000 crores. That is one level of detail, right? And we can also say that the company operates in 3 segments. And the segment revenues are 500, 300 and 200. This is another level of detail. Then we can also say that the 500, out of this 500, 50% comes from USA, 30% comes from India, 20% comes from Europe. That is another level of detailing. That is, we are going on adding the details. Now it depends on whether the data is available or not also. There are limitations to this also, right? The fourth point is, what are the factors that will help us do our required analysis? So for example, if we are trying to find whether a company is overvalued or undervalued, we need to find out the intrinsic value of a company, and we need to find out what is the price of the company at that stage. If we compare them, we can easily understand whether the company is overvalued or undervalued. Again, for example, if we want to understand the debt scenario of the company, we have to bank on debt to equity ratio. We have to bank on the interest coverage ratio, right? These kind of relationships will help us. Again, for example, let us see, let's say that we want to understand whether a company is asset light or asset heavy. There, what we have to find out is, for example, revenue to fixed asset ratio, or profits, that is net income, to fixed asset ratio. This can give us whether the company is asset light or asset heavy. Right. Again, there is a fifth factor also. We would write that is limitations to our analytics. I'll take a very obvious example, friends. Let's say we are searching for small caps with potential of growth. Small caps with huge potential of growth. Now let's say the market cap of the company is 100 crore. Right now the market cap of the company is 100 crore. We have the P&L statement, the numbers are good. We have the balance sheet, the numbers are good. Cash flow statement, still they are trying to decipher and get into a free cash flow state, but they have not yet gotten into. But profit and loss statement says they are growing at a good healthy rate, and balance sheet is also quite qualitatively quite in a good space. But can you really say that after 10 years this company will become 5,000 crores? What is the assurance about it? There is a limitation to the projection here, friends. So this also we have to understand, that how much we are able to predict or how much we are able to interpret a data. Till what limitations? Limitations in terms of time and space both. In terms of detailing and in terms of relative and absolute, in all these factors there are certain limitations and certain accessibilities also. So you have to understand where the limitations lie and up till where we are actually being speculative. So that's about it. Now we will try to construct a flow or a process through which the financial analysis is done. The first step that we have to take is define the purpose. Defining the purpose of the analysis. So the question that lies here is, are you trying to find out the intrinsic value of the company? Or are you trying to do a credit rating of the debt that the company has? Are you trying to value a merger and acquisition that is expected? Are you trying to relatively understand what is the position of a company compared to some other company or the industry? So relative valuation or relative evaluation. So the purpose or the context of the analysis has to be set first. The second step is to collect data. Obviously, the purpose and the context will define or influence what kind of data you require. For example, if it's a manufacturing company or a IT company and you want to measure the intrinsic value, you might need data like the free cash flow statement. You might need data like the profit and loss statement and the balance sheet, right? And you might need to find out what is the cost of capital. This kind of information you will require. To measure the cost of capital, you might need data like cost of equity, cost of debt. Cost of debt you can find out by the interest that is being paid in the profit and loss statement. Cost of equity you can find out by calculating the risk-free rate, the beta, and the market premium, right? So these are all the different data that you need to collect when you are basically analyzing intrinsic value. For credit rating, again, for example, for credit rating, you will need certain other data like the interest coverage, like the capex. They will have more importance, right? Interest coverage, capex, debt to equity ratio, the upcoming expenses, expansion plan. All these data are relevant in both the cases, but in some cases, some of the data take precedence. In some cases, some of the data take a backseat. We need expansion plan, capex, debt to equity ratio, and interest coverage first when doing a credit rating. In case of intrinsic value, we need to find out the free cash flows. For that, obviously, we need the capex data, but the interest coverage and all these things, we just take a look that whether they are okay or not. We may not go straight away into the depths of it, that what the interest coverage will be in the future. That projection may take a backseat for a while when you are using intrinsic value. Now the third is process data. So you have taken a lot of input data. Now you have to process the data. What is the example of processing the data? Just the one we took here. Let's say to measure the cost of capital, we need to first measure the cost of equity and the cost of debt. This we find out from, let's say, the interest payments and the net debt that the company has. We find out the cost of debt. The equity, for the cost of equity, let's say we use the CAPM method and we find it out, and then we do a weighted average of it to find the cost of capital. Weighted average, how do we find? We use the debt to equity ratio for that, right? So this is one way of processing the data. Number 4, analyze and interpret the data. Let's say we have measured the cost of capital of a company. It is coming to 15%. And the company has a return on capital employed of 30%. So we can say the company is earning well above the cost of capital. This is a good sign, right? In a scenario 2, let's say the cost of capital is 18% and the return on capital is 10%. This company is not in that much of a good scenario. So by finding out the return on capital and by measuring the cost of capital, we can actually find out whether the company's performance is qualitatively good or bad. We are actually using numbers to make some qualitative judgment about the company here. So this is analysis and interpretation of the data. After we have taken all these steps, that is, we have defined the purpose, we have collected the data, we have processed the collected data, we have analyzed and interpreted the data, what we do is we communicate recommendations. Recommendations means what, guys? It means whether to invest or not, whether to liquidate or not, like that. So sell, hold. This is one way of recommendations, you can say. After we have made the recommendation, which is backed by analysis and data, we have communicated it well, why we make a certain amount of recommendation. The sixth point is follow-up. A company which is in a good state today may turn bad. Something may come up suddenly. The markets may change. Some problem with the management may happen. Some process may go haywire like this. Again, a company which is performing bad may turn around and start doing well. Both these things have happened and can happen in the future also. So we have to follow up regularly. And if required, make changes as when required. And this is repetitively, if you follow this cycle, we are following a proper financial analysis technique. This is a proper flow of financial analysis technique which is repeatable, and if followed, this can give us the desired results. Contents of a complete research report. So friends, a research report is basically something that gives data, its interpretation, and the conclusive recommendation. Therefore, it simply implies that the recommendation has to be given, but it has to be backed by data and interpretation. Right? So, a complete research report has certain elements which are mandatorily there. What are they? Let's say we are trying to analyze a company ABC. This is a foods and beverages company. Right? This is a foods and beverages company. Many favorite brands and many famous brands belong to this foods and beverage company. Now, what we do is we summarize few things. What we summarize? Basically, what is the comparative scenario? Industry figures. Now, in terms of industry figures, what are they? Profit margins, operating profit margins, net income margins, P ratios, PB ratios. These are all industry level figures that we might mention here, and compare them with ABC's operating margins, net income, P ratios, PB ratios, etc. We may also look at the growth of the industry. Let's say the industry is growing at 8% and this ABC company is growing at 10%. So we make our remarks on that. Then comes the regulatory scenario. For example, let's say the company makes baby food or baby milk powder. Now we have to take care and see what are the approvals this company has. What is the regulatory scenario? Is there a chance that the company may fall into some kind of difficulty because of some ingredient being used? Is there such a possibility? Can the regulations change and put the company in some advantage or some disadvantage? These things have to be understood or analyzed. What else can we mention here? Some financial data. Financial and also some industry specific data. For example, what is the market share of the company currently? What was the market share 5 years back? And what is the projected market share maybe 5 years afterwards? Then financial data, what is the debt scenario? What is the profitability scenario? What is the credit rating and all that? How are the revenues growing? So these few things we summarize in the report. Next to this, we also come to some other points. For example, what is the management comprising of? we delve into the promoter details, the board of directors, and all that. We try to understand the experience of the promoters. We try to understand their historical performances. We try to understand what is the corporate governance scenario, right? Are they following the ESG parameters so that they do not get into trouble? Any contingencies do not happen in that respect. Then we move into certain other aspects like business specific parameters. For example, what are the segments they are operating in? And what are the segment growth rates? What are the geographical growth rates? And how maybe if the company has subsidiaries in foreign countries or different geographies, how are each of them performing? That data can be there. How are the brands developing? Are they entering some new segments? Are they doing some new mergers and acquisitions? Is their growth historically organic or inorganic? These kinds of data have to be there. Now, what we have to see here is when we summarize all these data, we mention both the historical data, the current data, and through our analysis, we are able to project the future also to some extent. So the past, the present, and the future. All these elements should be there in an ideal research report. Now, after analyzing all this, the business, the management, the finance, the regulations, the competition, the industry figures, let's say the credit rating scenario, the raw material situation. For example, if it's an F&B company and it is making milk products, what are the projected prices of milk or availability, supply demand equation of milk products, or the availability of raw material, that is which is milk, what is the pricing of that going to be? These things we have to analyze. Let's say they are making breads, what is the price of rice and wheat, for example, we may have to understand. So this is basically another parameter that we have to understand. What is going to be their cost of raw materials? What is going to be their cost of sales? What are they using for marketing? Are they using any brand ambassador? What is the cost of the rights they have taken for television, for digital, and what is the payment they are making to their brand ambassador? What is the proportion of the entire cost they are bearing only for the marketing? How much that is impacting the margins? So these kind of analysis, everything has to be there in the research report. There is no definitive that this has to be there the research report ends. The more comprehensive it is, the better it is. And out of all these analytics, after all these analytics, what we have to arrive at is basically a recommendation, a well analyzed, well interpreted, and well communicated recommendation which is convincing and qualitatively rational. Right? This recommendation should be to the best interest of the investor, and this should be arrived at after lots of comprehensive research. So that's what basically a content of a complete research report should have. And friends, when I use the word summarize, I am not talking about concising. I am saying you have to write all these things in a way that is not too expanded and it communicates the things crisply. You can also write, you have to explain in short or reasonably short form, reasonably concise form. It should not be too short that the target investor does not even understand why you are saying something, and it should not be too long that people while reading it get lost into the details. So that's about it. Summarize does not mean making it too concise. I just wanted to make a note of it. Analytical tools and techniques. So friends, when we are trying to analyze companies and compare different companies, there are certain ways to do it. For example, there is something called cross-sectional analysis. What is cross-sectional analysis, friends? It is basically analyzing for a single timeline an entire series of parameters for couple of companies or more than two companies. So, analysis for a single time period, a series of parameters. Let's say we are taking the entire profit and loss statement of two companies, A and B. We have net income, we have sales, cost of sales, other expenses, operating margin in both sides, sales, COGS, other expenses, operating margin. Then there are financial expenses, profit before tax, then there is tax, and there is net income, right? So obviously A and B are two different companies, so they will have different numbers. When we are doing a cross-sectional analysis, what we are trying to do is how each of these companies are performing in a comparative sense. Then there is time series analysis. Time series analysis means, let's say we have taken a balance sheet and a profit and loss statement, and we have taken 5 years of time. Year 1, year 2, year 3, year 4, year 5. Let's say year 1, the sales was 100, year 2 it was 110, then 120, then 130, 140. Okay? This is the sales numbers. This we have received from the profit and loss statement. Then we have also taken the receivables numbers. This we have taken from the balance sheet. In year 1, the receivables was 20. Year 2, it was 30. Year 2, it was 50, 60, 70. Now the trend analysis, what we can observe here is, initially the sales to receivables ratio was 20%. But later on, something gradually started to change. What changed, friends? The proportion of receivables compared with the sales started to increase. And in the 5th year, it turns out that sales to receivables is around 50%. So this is just an example of trend analysis using various parameters. A technique that we use to compare two companies which are otherwise incomparable in terms of size is called common size analysis. Let's say there is a company A whose sales is 10,000 crores, whose operating profit is 5,000 crore, and net income is 2,000 crore. And there is another company B whose sales is 100 crore. Its operating profit is 40 crore and its net income is 18 crore. Now obviously comparing these two companies in terms of absolute numbers becomes a little bit uncomfortable. So what we can do is, we can divide all these numbers by the sales and get the percentage values. So if we divide 10,000 by 10,000, we get 100%. right? If we divide 5,000 by 10,000, we get 50%. If we divide 2,000 by 10,000, we get 20%. So the common size figures for P&L will be, for A, sales is 100, operating profit is 50, net income is 20. For B, if you divide 100 by 100, it gives you 100%, 40 by 100 gives you 40%, and 18 by 100 gives you 18%. So now these numbers are much more comparable, much more easier to comprehend when they are together. So this is something called common size analysis. We get these numbers by dividing all the numbers by revenue also. Sometimes we divide it by assets also. And this common size analysis can be done for profit and loss statement and also balance sheets. Okay. The last but not the least factor or the technique that we use is ratios and ratio analysis. Ratios and ratio analysis. There are various factors that a company has to take care of. It has to take care of liquidity. Liquidity basically means it should be able to meet its short-term obligations. Short-term obligations. This can be operating expenses, short-term debt, etc. Then there is solvency. Solvency means the company should be able to meet its long-term obligations, which basically means it can be long-term debt. Then the company has to take care of its activity parameters. Activity parameters means the company should be able to maintain a healthy level of receivables, inventory, etc. So that compared to the revenues, they are not too low, not too high. Then there are profitability parameters. The company should be able to have a healthy net income, a healthy profit before tax, a healthy operating margin, etc., etc. A healthy gross margin. All these numbers become important. Then the company also has to take care, most importantly, last but not the least, its valuation. Its valuation in terms of, say, pricing, which is, for example, P ratio, PB ratio, or for example, its enterprise value, or for example, its discounted cash flow valuation. All these numbers have to be attractive for an investor to invest, or the existing investors must feel that they have made the right investment. So these parameters a company has to take care. And to keep a watch on these parameters, the easiest and the most convenient way is to find out the related ratios and keep track of them. So, for example, liquidity. To measure liquidity, there are ratios like current ratio, quick ratio, cash ratio, which take care of liquidity. For solvency, there are ratios like interest coverage, right, which take care of how good the solvency is. For activity, there is inventory turnover, there is days receivable. So activity ratios can be inventory turnover, days receivables, etc., which help us monitor the activities. In terms of profitability, obviously net interest margin, profit before tax margin, operating margin, gross margin, these numbers become very important. In terms of valuation, for example, the pricing kind of valuation methods, P ratio, PB ratio, all these things can be used. In terms of absolute valuation figures, intrinsic valuation, discounted cash flow valuation, enterprise valuation, these numbers become important. First, we take a look at the liquidity ratio. In liquidity ratio, there are various calculations like the current ratio. Current ratio is basically the ratio between the current assets and the current liabilities. Obviously, it is preferable to have higher current assets and lower current liabilities. So a preferable number for this is greater than 1. The lower the number is, if it is less than 1, it implies that liquidity is low. Then there is quick ratio. The quick ratio basically uses cash, short-term marketable assets, and receivables. This is the numerator. This numerator is divided by the current liability. So what is the difference between current ratio and quick ratio, friends? In current ratio, the numerator is current assets, which means cash plus short-term marketable securities plus receivables plus inventory. So inventory is something which is included here. But this inventory is eliminated in case of quick ratio. So what we are doing is we are only using the liquid portions, very liquid portions, much more liquid portions of the current asset than what is used in current ratio. So this is a more conservative way of looking at liquidity. An even more conservative way of looking at it is cash ratio. This uses only cash and short-term marketable assets or securities. This portion is divided by the current liabilities. This is an even more conservative ratio to measure liquidity. So basically these three ratios are a way of finding out how much a company is capable of catering to its short-term obligations. Short-term obligations is obviously its current liabilities, and how it is going to cater to it by having enough cash, enough short-term marketable securities, and enough receivables and inventories to balance it. Now there is one more ratio, friends, which is called defensive interval ratio. This uses the same numerator as the quick ratio, which is cash plus short-term marketable securities or investments or assets plus receivables. Now this numerator is divided by daily cash expenditure. Daily cash expenditure. This gives you a figure that, considering the current level of daily cash expenditure, how many days the company can sustain with the current cash, short-term securities and receivables. There is one more liquidity ratio which is called the cash conversion cycle. This one we will come in a short while after we have understood the activity ratios, because this will require the use of activity ratios for calculation. This is called cash conversion cycle. We'll come back to it. For now, we will move to solvency ratios. So friends, solvency ratio is basically the capability of a company or measurement of a capability of a company to meet its long-term obligations. Now these can be divided into two kinds. One is the debt ratios and another is the coverage ratios. The coverage ratios are basically the solvency measures that primarily originate from the profit and loss statement. The debt ratios majorly, not all, but majorly originate from the balance sheet. Now let us see what these ratios are. Let's first understand the debt ratios. The first of the debt ratios is the debt to asset ratio. This is basically the ratio of the total debt divided by total assets. Now, total debt here is defined by interest bearing long term and short term liabilities. Again, I'll repeat, total debt here is represented by interest bearing short term and long term liabilities. Debt to capital ratio. This is the ratio of total debt, again the same definition, divided by the sum of total debt and shareholders' equity. Here the total debt remains the same. The definition of the total debt remains the same. Now, for a debt to asset ratio, let's say of 0.5, this means that the total asset is just the double of the total debt. This is very obvious, right? Same, we can figure out the in the same way we can figure out the number of debt to capital ratio. Now, one critical thing we need to understand is what is the difference between total assets and total capital. This we have to understand, friends, because these two terms otherwise do not differentiate properly. I would try to interpret this. Total capital is equal to total assets minus non-interest bearing short-term liabilities. Non-interest bearing short-term liabilities. A typical example is supplier's credit. You can specifically understand here, friends, when we use the definition of total debt, we specifically used interest bearing short-term and long-term liabilities. Supplier's credit is also a liability, but it does not bear any interest, so we are not going to include it in total debt. Similarly, to differentiate between total capital employed and total assets, the differentiating factor is the total capital does not include non-interest bearing liabilities or non-interest bearing short-term liabilities. So this is the difference between capital and asset. Now comes debt to equity ratio. This is equal to total debt by shareholders' equity. Let us just write equity for it. Financial leverage ratio. This can be defined as average total assets divided by average total shareholders' equity. In practice, end of period total assets and end of period total equity is also used. Now we will try to understand leverage, the different kinds of leverage in a short while. First, let us understand the fifth ratio in the debt ratio category of solvency ratios. This is debt to EBIDTA ratio. This is basically total debt divided by earnings before interest, tax and depreciation and amortization, which is basically the full form for EBIDTA. This basically makes us understand the earnings before interest, tax and depreciation, whatever we are earning, how many times of that we have taken up as debt. The lower the number, ideally the better it is. In case of financial leverage ratio, the higher the equity proportion, the better it is. That is, the lower this number is, the better it is. That is, the closer this number is to 1, the better it is. And the further away it is from 1, that is, if it is a lot greater than 1, then that smells red signal. Similarly, total debt, total equity, the higher the number, means the higher the debt, and that is not a very good sign. A debt to equity of less than 1 is generally a better sign. The lower it is, the closer to the lesser it is to 1, or the closer it is to 0, the better it is. Similarly, debt to capital, if it is 0.5, that means debt and equity are equal. So if this number is lesser than debt 0.5, then it's a good sign. If it is more than 0.5 going upwards, then it means it's a bad sign. If it is very close to 1, that means there is very less amount of equity, which is a very bad sign, right? You do not want that. Similarly goes for total debt by total assets. If there is 0.5, if the number is 0.5, that means the equity and the debt are almost evenly balanced. But the closer it gets to 1, the worse the number is. You do not want that. Friends, now we come to the coverage ratios. These are basically ratios taken from the profit and loss statement. How they are calculated, let us see. The first one is the interest coverage ratio. This is basically the ratio between EBIT and interest payments. So EBIT means earnings before interest and taxes, and interest payments obviously are the interest payments for the period. So the higher the number, the better it is. The more the EBIT is, the more the multiple of EBIT is compared to the interest payments, the better it is. Fixed charge coverage ratio. This adds a certain factor to the interest coverage ratio. This is basically EBIT plus lease payments divided by interest payments plus lease payments. Okay, so this is the ratio. Now we are in this case also taking into account the lease expenses that are incurred. This is called the fixed charge coverage ratio. One variant of this basically assumes that the lease payments can be divided into two parts. That is, 1/3 is the periodic payment and 2/3 is the principal payment. That is, 1/3 is the interest part and 2/3 is the principal part. And if this assumption holds, then this formula changes to EBIT plus 1/3 of lease payments divided by interest payments plus 1/3 of lease payments. So that's about it for the solvency ratios. Now, as we spoke about leverage, we will try to understand what leverage is and how many kinds of leverages are there. So friends, what is leverage? Leverage is basically the magnifying effect on the profitability number, especially, which happens by introduction of financial or non-financial fixed costs into the system. So let us write the definition. So leverage is the magnifying effect that happens due to the introduction of fixed costs, which can be financial or non-financial in nature. When the fixed cost is non-financial in nature, the leverage is called operating leverage. And when it is financial in nature, the leverage is called financial leverage. Let's take an example, friends. Let's say a company has the following revenues in the 5 years without any leverage, without any additional leverage. Let's say it is 110 crore, 70 crore, 90 crore, 130 crore and 100 crore. These are the sales yearly. Now this is without the operating leverage or financial leverage of any kind. Now what happens is a certain amount of operating leverage and financial leverage is added. Let's say a new plant is added, which is having an expense of 50 crores, and that 50 crores is divided between debt and equity into 25 crores and 25 crores. So 25 crores maybe the company uses from its own balance sheet cash, and 25 crores it takes as loan. Now the repayment will happen uniformly across the future 5 years. So this 25 crores is the total expense for financially, and this 25 crores is also in terms of operating leverage also the total expense. So this increment is in cost is 5 crores in each year, right? Now let's say the introduction of this plant results in increase of revenue by 15 crores each year. So the new set of revenues becomes 125, 85, 105, 145 and 115. So this is an increment of 15 crores each year that we are assuming, right? Now let's say the variable cost is 50%. Variable cost is 50%. And the fixed cost, both financial, non-financial included, before addition of this additional cost or additional leverage, this was 20 crores. So we write these numbers 20, 20, 20, 20, 20, right? And this is 50%. So for the new net income, the variable cost is 62.5, 42.5, 52.5, 72.5 and 57.5, right? So these are the costs. Now if we have to find out the new net income, this comes to be the new net income. This will be calculated as 125 minus 62.5 minus 20 minus 5 minus 5, right? So we do the calculations, guys. This comes to be 32.5. This is 12.5. 22.5. 42.5. 27.5. These are the new net incomes, right? These are the new net incomes. What about the old net incomes? So old net income will be, for example, for time 1, this will be, let me use different colors here, 110 minus 62.5 minus 20. So old net income without the addition of the financial leverage and the operating leverage, this will be equal to 110 minus 62.5 minus 20. So this is equal to 110 minus 27.5. This 22.5. So you can see there is an increment of 5 CR in every of the values. So this is the magnification that we are talking about. This magnification has been achieved by the addition of financial leverage and operating leverage. Now there is a downside to it, my friends. Let's say the revenues increased anywhere between 0 to 10. That is, whatever cost got added, the added revenue was less than that. Let's say the added revenue was only 7 CR each time. So the new revenues become, let us write the new revenues in this scenario. The revenues in this case become, so we have increased the revenues only by 7 crores by adding this additional cost, right? So this is 117, this is 77, this is 97, this is 137, this is 107. So these revenues, we add 7 crore to it. Now the expenses remain the same. This is 5 plus 62.5 plus 20. So we have to reduce that. Let us see what is the new expense coming. This expense is coming to 5 plus 5 plus 62.5 plus 20. This is coming to 92.5. Therefore, the profitability here is coming to be minus 117 is 24.5. So the old net income would have been 27.5, but because the expense that got added was not compensated by the resulting revenue increment, the new revenue in this case, in this second scenario, that is the new net income in this second scenario, actually decreased. Instead of increasing, it went down to 24.5. Similarly, if you calculate all these values, you will see there is a reduction in 3 CR in profitability. So this will become 4.5, this will become 14.5, this will be 34.5, and this will be 19.5. So all of them will be reduced. So this is basically what we mean by the magnifying effect. Either we are amplifying the net income or we are de-amplifying it by addition of leverage. If the addition of leverage is successful, we end up magnifying it positively. If it is not successful, then we end up de-magnifying it or magnifying it negatively. Now next we are going to get into the activity ratios. So friends, now we will talk about the activity ratios. Activity ratios are basically ratios which indicate the operating efficiency of a company or how well the assets are being utilized of a company. Therefore, the other names for activity ratios are basically asset utilization ratio and operating efficiency ratio. Now there are a series of activity ratios that we are going to discuss. Among them, the first one is the inventory turnover ratio. This is defined as the cost of sales or cost of goods sold, or cost of goods sold divided by average inventory. Right. So let's say the cost of goods sold divided by the average inventory comes to a value of 4. This means that within a certain period, the inventory is liquidated 4 times. So let's say the period is a year and we have a cost of goods sold by average inventory giving a ratio of 4. That means the inventory was liquidated 4 times during this period. What is the definition of average inventory? It is basically the inventory at the beginning of the period plus the inventory at the end of period divided by 2. This is the definition of average inventory. Okay. Now the second ratio that we come across is days of inventory on hand. Days of inventory on hand. This is defined as the number of days in the period divided by the inventory turnover. Number of days in the period divided by inventory turnover. So let's say we are talking about 1 year period and the inventory turnover was 4. Therefore, days of inventory on hand will be calculated as 365. That is the number of days in the period. If it is 1 year, the number of days is 365 divided by 4. This comes to 91.25. What does this number signify, friends? Basically, this signifies that the inventory to get liquidated once completely takes 91.25 days on an average. This is what it signifies. Typically, the lower this number is, the better it is. And for inventory turnover, the higher the number is, the better it is. Now we come to receivables turnover. Receivables turnover is defined as sales divided by average receivables. Average receivables again is basically receivables at the beginning of the period plus receivables at the end of the period divided by 2. Now let's say this number is 3. Sales by average receivables, the number is 3. This means at any time 1/3 of the sales is outstanding in terms of receivables. So the money has not yet come to the account. 1/3 of the sales has not been accounted for, or the money for that has not been received yet. Days of sales outstanding. Days of sales outstanding is basically the number of days in the period divided by receivables turnover. Divided by the receivables turnover. Now let's say the receivables turnover is 3 and the period is 1 year or 365 days. Therefore, the DOS or day sales DSO, this will be DSO. So let's say the period is 1 year, which means 365 days, and the inventory turnover is 3, as we mentioned earlier. Therefore, the day sales outstanding will come to 121.67. This means that over the period, whatever sales are made, out of that 121.67 days of sales are outstanding in terms of payments. So generally, the lower this number is, the better it is. Inversely, the higher this number is, the better it is. That is, the receivables is much lesser in proportion in terms of sales. This signifies payables turnover. This is defined as the amount of purchases in the period, divided by the average trade payables. Average trade payables. What is the definition of average trade payables? It is basically the payables at the beginning of the period and payables at the end of period divided by 2. Right? So let's say this number is 5. That means 1/5 of whatever purchases are made, the payment for that is outstanding for that period. Right? So generally, having a comfortable number here is good. A low number can be good for this, but too low may mean there is cash crunch and the suppliers are not being paid properly. That can also be the case, right? Number of days payables. This is basically number of days in the period divided by payables turnover. Number of days in the period divided by payables turnover. If the payables turnover is 5 and the period is 1 year or 365 days, this comes to be 365 by 5. This is equal to 73. So basically, in a single period, 73 days of purchases are not paid for in that same period. They are outstanding. So this number should be healthy, should not be too low, but should not be too high also. That can also be an indicator of liquidity crunch. Now we come to working capital turnover. This is basically the sales or revenue for a single period divided by the average working capital. Working capital. The definition of average working capital, again guys, is basically working capital at the beginning of the period plus working capital at the end of the period divided by 2. Average of it, right? So let's say this number is 3. This means say the currency is in dollars, so $1 of working capital produces $3 in revenue or sales. Generally, the higher this number is, the more efficient the usage of working capital is considered to be. Fixed asset turnover. This is basically signifying how efficiently fixed assets are being used to generate revenues. So this is again sales or revenue divided by average net fixed assets. Again, the definition of average net fixed assets is basically net fixed assets at the beginning of the period plus net fixed assets at the end of the period divided by 2. Now let's say this number is 2.5. This means $1 of net fixed assets or average net fixed assets is producing $2.5 of revenues or sales. So generally the higher the number is, the better it is. Same goes for total assets turnover. This is sales or revenue divided by total average total assets. Average total assets is basically total assets at the beginning of the period plus total assets at the end of the period divided by 2. Here let's say the number is 1.5. This means that $1 of assets is producing $1.5 of revenue. Generally, in this simple manner, we can understand that the higher this number is, the better it is.